Greetings from 3Edge Asset Management, and welcome to the 3Edge Week in Review for December 14th, 2020. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and I'm pleased to be joined here today, once again, by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. This week, along with a brief update of the global capital markets, Steve and I will take a preliminary look back at 2020. In addition, we'll consider some of the potential risks that could be on the horizon in 2021. A brief programming note: since Christmas and New Year's Day fall on the next two Fridays, this in fact will be the final 3Edge Week in Review for 2020. Steve and I will pick things back up in early January of 2021. So let's get started. Take a quick look at the activity in the markets this week. Global equities advanced for the week, and in fact, on Thursday, the S&P 500 closed at yet another all-time high. Investors have been focused on the ongoing negotiations in Washington on a coronavirus relief package, as well as the rollout of the first coronavirus vaccines in the U.S. And the Federal Reserve's stated commitment, after 2 days of meetings this week, to continue their easy monetary policies for the foreseeable future. So Steve, the final weeks of the year are here, and we've heard 2020 already described as unprecedented and a year like no other. And I think that most of us would maybe tend to agree that 2020 is felt like that kind of a year. But just in case people aren't sure of just how extraordinary 2020 has been, why don't we look at some of the most important economic and market events of the past year?
Well, you're right, Fritz. It's been a truly record-setting year. For instance, we had the worst global pandemic in over a century. We had the steepest market decline in history. We had the lowest interest rates globally ever recorded. We had the sharpest increase in the unemployment rate from the lowest it's been in 50 years to higher than it ever got in the financial crisis of 2008 in a very short time. We had the strongest burst of monetary stimulus from the Federal Reserve Board and other central banks in history. And as a result of that, we had, following the steepest decline ever recorded, we had one of the most rapid stock market recoveries on record. So it's truly been an extraordinary year of extremes as far as the economy and the markets go.
That's an impressive list of things to have occurred in a single year. So I was thinking that, as we know, oftentimes when you think about investing, things that look logical in hindsight are much messier, in real time. So in follow-up, I think it might be interesting to discuss how our research model interpreted events as they actually unfolded over the course of the year, particularly since, this year was an example that many of the signals from our model led to asset allocation decisions by our investment committee that really seemed quite contrarian at the time. So maybe you could just walk us through a little bit of how the model saw the year progress.
I think it's a good time to step back and have some perspective, because with so much volatility during 2020, it's easy as an investor, any investor, to get caught up in the news flash of the moment, or to get emotional by the volatility and how the markets are getting whipsawed. And history shows over and over again that it's human nature for investors to buy at the top and to sell at the bottom. And we saw that again this year. So I have to say, in 2020, it was especially comforting as an investment committee and as chief investment officer to have a research process and a model with a solid, rigorous scientific foundation behind it that helped us sort through the noise and really capture the key cause and effect relationships that were the most important determinants that really made the difference, and to anchor ourselves and not let ourselves get trapped in that same emotion that gets any investor. So for example, if we go back to early 2020, we were setting new stock market records at that time. But the economy, the global economy was slowing down, despite the stock market continuing to make new records. And valuations, especially in the US, were getting more and more stretched. So even though at the time it was very contrarian and the popular thing to do is just keep piling into the market, we became defensive at the risk of missing out on further gains. But it proved to be very, very beneficial for our clients, because by being defensive in early February, when the market started the downturn, we really missed the lion's share of that downturn. And our clients were a whole lot safer than someone who stayed in the market. And we missed the lion's share of that big drop. Then the data shows how during that big drop, massive selling was occurring in mid to late March, and it coinciding right with the bottom. And it did seem like the market decline had no end in sight, and it was going down, down, down. But then two important things happened that our model helped us really gravitate toward. And one had to do with tremendous, massive market intervention by the central banks that really started in the last week of March and then continued into April. And our models were able to cut through all the noise of the market and pick up the important change in the risk-adjusted projected returns, coupled with the fact that now that prices have come down so far, valuations were no longer heavily overvalued, but were fairly valued, and in some cases, especially outside the US, undervalued. And in that way, despite all the emotion to be fearful of the market and stay away, we actually began reinvesting in early April. And that helped us, on the upside as well, participate along with the market. One other contrarian item was that as the market recovered and more people got reinvested over time, the focus was again on US stocks and bonds, which had outperformed over the last decade. And our models, again, being contrarian, but not just to be contrarian, because of the economic and valuation factors, saw that there was better value outside the US, and that bonds were particularly overvalued where the central banks brought interest rates incredibly low. Right. And real assets had more opportunities. So we began investing not just conventionally into US stocks and bonds, but more into non-US stocks in more real assets than fixed income. And now we see that that has proven to be the place to have been over the last few months.
Good to have a model, good to have that discipline. So we've got a few weeks left, and it seems that 2020 will turn out to be a good year for the equity markets. Although, obviously, as you mentioned, February and March, it didn't feel like that would be the case. But as you said, an important part of our job is to not only generate attractive returns, but also to preserve client capital should we encounter a market downturn. So why don't we at least take a look into 2021 and think about at least the potential risks, the potential risks that we could face in 2021 and beyond. And just so to reinforce the fact that it is important to remain vigilant at all times.
I agree. And from time to time, I remember the line of a Grateful Dead song. And to paraphrase, it basically says that when life seems like easy street, there's danger at your door.
St. John's, Uncle John's Band.
Good for you. You get 10 points. Never knew you were a deadhead. But anyway, good time to remind ourselves, because things seem like they're going so well in the markets. Right. They can do no wrong. That's just when you need to focus on risk. So I agree with that, Fritz. And so we prepared a chart to just list some of our key risks. The first on our list deals with geopolitical instability. And there are some hot spots around the world. Iran is a particular hot spot. And there's been increasing stress between Sunnis in the Middle East and the Shiites in Iran. There's been increasing stress between the U.S. and Iran, and it's not clear how that's going to unfold in the new administration. Secondly, there's increasing tension between China and Taiwan, and I know that there are people in the Defense Department that have said that certain lines have been crossed in their normal wargaming, et cetera, and so that bears some special watching. North Korea might decide to test the new presidency and missile and start a new round of tensions. Russia, we see, is, the evidence is getting stronger that they're behind major cyber attacks, and we're only beginning to get under the surface as to how serious they might be. And cyber warfare is something that we should all be concerned about. And then finally, Brexit. There's been a feeling in the markets that we're only very close to a great agreement with Brexit between England and Europe, and that's going to set the stage for continued growth, not just in Europe, but for the global economy. So there's always some small chance that things go wrong at the end, and that causes ripples through the global economy. Next, the potential for tax policy changes that are not anticipated right now in the market, and that is that there's a fear, whether it's founded or unfounded, there's a fear that if Democrats win both of the open races in early January in the Senate in Georgia, that then the Democrats take over the Senate, and that maybe we get massive increases in taxes. Now, one could argue that it doesn't make sense to raise taxes while we're still in a down economy with the unemployment high as it is. And even if the Democrats do take over the Senate, it'll be hard enough to get a majority to vote for any major tax increases. But that's not the point. The point is the markets might fear a big spike and could come off. COVID, we had lots of good news recently about a vaccine, but in the short term, COVID's going to get worse before it gets better. Now, if the vaccine gets distributed quite quickly, and an important if, sufficient number of people agree to take it, then we can call herd immunity, where enough people develop antibodies so that the coronavirus doesn't have enough hosts to continue to expand and it finally dies out. So the risk would be either logistics get caught up or sufficient number of people refuse to take it, which would be very unfortunate. And the coronavirus lingers enough to have another wave next winter. So that would be not so good. People forget that before the coronavirus hit, the global economy was already starting to slow. And so we could have a situation where when the global economy gets back to normal and there's no more excuse from the coronavirus, it might not grow as fast as people expect. Next, because the Fed intervened so much and brought interest rates so low and backstopped a lot of corporate lending and corporate debt, credit spreads are incredibly narrow. It's been really easy for corporations to borrow. And borrow they've been doing, we're at record levels of corporate debt. And that's okay as long as interest rates stay low and credit spreads are the difference between what it costs for a corporation to borrow versus the government stays low. So the risk is, what if something happens to increase those credit spreads? Our models are showing a high degree of sensitivity to the credit spreads. So that's something we're watching very closely. Finally, we all know that monetary policy operates with a lag. And we've got all the central banks in the world, including our own Federal Reserve Board, printing money, doing everything they can to fight deflation and to get things rolling again. And so what happens if the lagged effect of that really hits next summer at the same time when the vaccine is really helping, and it's just so much stimulus from the real economy and from the market economy all at the same time, that we get a burst of inflation, that they try so hard to create inflation, that they actually succeed even beyond their expectation. Well, then that leads to our last point, which is the Federal Reserve Board might decide to call off the money printing, to call off the low interest rates, and start tapering that stimulus. And just like everyone asked, well, how can the market do so well when the economy wasn't doing so well? People might start asking months from now, why is the market doing so poorly when the economy is doing so well? That flip. So just not to end on a sour note, I just want to make a comment. And as a director on the board of the IHME tracking the coronavirus, the news on the vaccines have been in our absolute best case scenario. And I think good news for the world. So I want to end on that positive note going into 2020.
Absolutely. Great. And also, those are risks. That doesn't mean that those risks come to fruition, but those are the things that we're looking at as potential risks in 2021. So that was terrific. And now, before we sign off, I want to thank you, Steve, for being part of these 3Edge Week in Review videos this year. We really have heard from many of our clients and many of our listening audience just how helpful, insightful, and also reassuring your insights into the markets have been during this extraordinary year. So I want to thank you for that.
Well, Fritz, I just want to say that when we started this, it was during the extraordinary volatility back in February and March, and we thought it would just be a temporary set of videos that we would do. And then when we got the feedback, we decided this would be something we would continue. And I just wanted to recognize and applaud you, Fritz, for every week being very diligent, putting a lot of effort into these videos and really capturing what's important. So thank you, Fritz.
All right, great. Well, it's been a pleasure. So that will do it for Steve and me. As I mentioned at the top, since Christmas and New Year's fall over the course of the next 2 Fridays, today's video will be the last 3Edge Week in Review for 2020. Steve and I will be back with 3Edge Week in Review starting again in 2021. And just to follow up on Steve, and in closing, as we approach the end of a year that, it's been difficult on many levels. We want to say that on behalf of everyone here at 3Edge Asset Management, we want to say how grateful we are for our clients' continued confidence in our firm. We're very proud of what our 3Edge team has accomplished this year, despite the challenges posed by the onset of a global pandemic. And this year has also provided valuable lessons that go beyond investing. And perhaps first and foremost, 2020 has reminded us once again that the world that, sometimes we take for granted as being stable, well, in reality, it can be tenuous. But it's also reminded us that even in the darkness of a global pandemic, there can be light, there can be hope. So on behalf of everyone at 3Edge, we wish you and your family a safe and happy holiday season and all the best for the coming new year. Keep the faith. Thanks for listening, and we'll see you in 2021.